Hello everyone, today is Friday, June 18th, 2021. My name is Evan. Welcome back to our weekly stock market analysis video. If this is your first time tuning in to one of our videos or this channel in general, thanks for joining us. Thanks for tuning in. Here's how our weekly market analysis works. We break this video up into two parts. In part one, we look at everything that went on this week in markets. We take a fairly macro approach. We look at things like correlations and volatility, term structure, credit markets, interest rates, all the good stuff, and pick apart everything that stands out and looks interesting. And there was a lot that stood out and looked interesting from this week of trading. So you're definitely going to want to stay tuned for this week's video. In part two, we jump into the charts. We look at those longer term trends. We put everything from part one into context and then try and best position ourselves looking ahead. So hopefully that sounds good to you. There's lots to talk about. So let's dive right in here to some of the big takeaways and some of the big movement that went on this week in markets. Now, it really sort of stemmed from the FOMC meeting we had on the books earlier in the week on Wednesday. We had the Fed come out and basically raise their inflation expectations. And what that essentially did is kicked off a chain of events. The most important was the short end of the yield curve really spiking to a very accelerated, faster, higher level, right? We saw a short-term spike in short-term interest rates. And what that does is it causes this ripple effect, mostly then by the US dollar, which then sort of reacts and resets in relation to these new rates. And the dollar ends up ripping to the upside. And then the dollar ripping to the upside then sets off more chain of event actions, which bleed into equity markets. Financial stocks are getting hit, commodities are getting hit and moving in relation to it. So we had this bit of a chain reaction reset this week, and lots of areas of the market really saw some outsized movement. Interest rates, credit markets, the dollar, commodities, financials, energy, all of these were really moving this week. The only thing that sort of stood alone and the same, and it is probably what the majority of all of us trade here, is technology and growth Nasdaq stocks. So if we look here at the equity market performance this week, look at this right-hand column here. One of these looks a little different than everything else, and it is the Nasdaq 100, which basically went through this week entirely unfazed and in fact up a little bit on the week. Meanwhile, we have the Dow Jones down 3.5%, the Russell down over 4%. So depending on where you were this week, you felt this week in a much different way. You're either sort of enjoying the weekend here, not thinking much happened, or you're looking back at this week saying, wow, that was a bit of a rough ride based on how things have been. So that's why we've got lots to talk about. Let's continue on here and take a look at our usual sort of sequence. We're going to start with market internals, and you can see market internals were strong on the week, but notice these numbers are basically drying up a little bit as the week went on. So if you look at the first row here, this is the NYSE number of stocks hitting 52-week highs minus lows. So we were up 260 on Monday, fell to 169 Tuesday, 163 Wednesday, 117. This number's probably not as low. I had to pull this number because I record these videos right after the close. They're sort of unsettled values, so I don't have the pure sort of final number here. So it might be higher than this, but I think the trend is going to continue that we slowly sort of weaken throughout this week, and that's something we're definitely going to want to pay attention to. If you look at the second row here, this is the cumulative sort of AD line on the day, and you can see every single day here was negative, which basically says that every single day this week we saw net number of stocks declining on the session. Furthermore, if you look at the third row, here's the percentage of stocks over 20 SMA in the S&P 500. That's down to 24% now, which is one of the lowest readings we've seen in a very long time. So all of this is to say that we are seeing the weakening underneath the hood right now as market breadth sort of deteriorates. I want to be a little bit cautious because, you know, when we look at this chart here, this still shows that there is an uptrend that is still very much in place here in terms of stocks hitting 52-week highs. We're starting to flatline just a little bit right now. We're going to want to see what the final numbers come in on Friday look like, and then how we react going into next week. But this is something I'll definitely be paying close attention to next week to see if we start to flatline and roll over. That would be a very negative sign here in my eyes for the market. Now, if we look at sector performance, this basically kind of reiterates here that the breadth was pretty lousy this week. We, in fact, only had one sector that was green, and again, it was technology, and it was basically barely green. It was essentially flat, up 0.03%. Everything else was negative here. So we had tech, consumer discretionary, and healthcare in the top three. And on the downside, we had materials, we had financials, and we had energy, which were all down 5 to 6%. So some very large down moves there in each of those sectors. If we look at correlations, here's a couple of things that I think really kind of illustrate what was going on this week and kind of the new, correlations and trends to sort of pay attention to. So if we look at the dollar, so that is this UUP symbol here, that's our proxy for the dollar, you can see that we have a almost perfect inverse correlation to what the dollar's doing and what the Dow Jones is doing. So basically what that's telling you there is that as the dollar saw its largest move to the upside in over a year, we had the Dow Jones seeing one of its largest down weeks in about a year's time as well. We're seeing that move in lockstep. The same goes for the S&P 500, not quite as tight of a correlation, and the same thing goes for the Russell 2000. Notice, though, the Nasdaq is totally avoiding this, right? The Nasdaq is not caring about what the dollar is doing. But if we go down just a couple of lines here, take a look at this percent TNX. This is the 10-year yield, and look at the minus 0.5 correlation with the Nasdaq. So what this is basically illustrating here, and negative 0.5 is not a super strong inverse correlation, but it's notable. And what this is basically telling us is the same thing we almost always talk about, is that it's really the yields that drive the Nasdaq performance, right? As yields spike, right? As we saw, essentially, think back 3 months ago as TLT was getting crushed, right? As the IEF, as the 10-year yield was rising, bond prices were falling, the NASDAQ was getting crushed, and it was this rotation into energy, financials, industrials, and Dow Jones stocks. Well, now the exact opposite is happening this week. We're getting, in fact, the TLT rallying and seeing one of its biggest moves to the upside, and that is allowing the NDX, the NASDAQ, to outperform like it did on this week. So all of these sort of markets are connected, right? They're correlated, and this is why we go to such lengths to look at all of these other views. Price is interesting, price is truth, and price is something we all need to pay attention to, but we can gain better insights if we look at things like correlation, volatility, market internals, and all of the things that we talk about here on a week-to-week basis. So those are definitely the two notable standouts there that I want to talk about, is the dollar and then some of that TLT performance. And if we look at volatility this week, we essentially saw two things happen. It was a very interesting week. I mean, everything has its place here on what's notable. The blue line is this week's VIX term structure, and the orange line is last week's VIX term structure. So basically, we saw essentially volatility rise across the whole term structure. So essentially, there's more fear in the market, if we want to just say it like that. And what's also noticeable, though, is that the front month contract here, so the VIX, as we all look at it, so the 19.47 value of the current VIX value, has risen quite a bit relative to the 3 month. So the steepness that we've been seeing in the market is starting to kind of come back down to really just more levels. But what we do need to be careful of is if we do continue to see this VIX spike and then we move into something that looks, like an upside down, it starts high and then it goes down, then you're in a term structure of backwardation, and that is where things get can get very loose, aggressive, and worrisome for equity markets. We're not there. I'm not implying that we're going to go there, but this is again why we look at things on a week-to-week basis, so we can at least be prepared and keep an open mind on the possible scenarios. Interest rates and credit markets. So this is where all the fun was. In fact, really I should have included the 1 year or the short term, kind of even lower than the 5-year yield in this table. Maybe I'll add it in here because I only have the 5-year yield, but basically look at the 5-year spiking 18%, right? And so we even actually saw more movement in the shorter term duration. And then if you look out here in the 10 and the 30 year, you're getting the exact opposite happening. And because that simply is, or is a simplification of that explanation, is because the Fed does not control the long end of the curve, right? They only have their finger on the short term, their overnight lending rates and everything, 1 year or less. So they don't really dictate what happens on the long end, but it certainly all influences in one way or the other. But that goes to show the sort of disparity we saw this week. And if we look at investment grade bonds and high yield bonds, I think this is actually kind of interesting and notable and somewhat encouraging, is the fact that we're not seeing any big dislocation or warning sign here in terms of the credit markets per se. We're still seeing, we saw down J&K weekly performance, but nothing that screams to, pay attention to, or something that's, grossly out of line at this time. If we look at dollar and commodities, again, here we saw a huge move for the dollar index. It was up 1.89%. And we saw basically all of the commodities getting hit in lockstep with that. So gold was down 6%, silver was down 7%. Those are huge moves for those particular commodities. We saw Bitcoin down 9%, which, on a relative basis, I guess, isn't that absurd of a move. It is a higher volatility asset. Agriculture, so the ETF DBA here was down almost 6%. Natural gas was down 2%. Look at crude oil, though, is still sort of championing the leadership here on commodities. It is still the strongest of the bunch here, and that crude oil trade is continuing to just work and power itself higher. So the report card on the week, even though there was lots of movement, we still had two saving graces. We had market breadth, which is on the decline. So the second derivative, right? The rate of change is going down. So we do need to be careful, but it is still supporting this market right now. So let's keep that in the check mark. And credit markets aren't falling apart yet. They're still holding things together. So all in all this week, give it a C in terms of performance, but we're definitely going to keep a close eye on a lot of these things that we talked about. In terms of our positioning here, so we've got an interesting positioning here. It's basically all in the market, which is a little scary. And let's sort of break it down and explain kind of what's going on here. So Merlin, our top system here, is basically been in this stance its entire last 6 to 8 months at this point. It has essentially been a long the market anywhere from 75 to 100%, and that's been consistent. And it's been pretty much in tech stocks and growth stocks and biotech and that type of space. And it ventures out a little bit, but it's concentrated there. So when I look at the performance from Merlin this week, it was actually pretty constructive, or it wasn't bad at all, because it was essentially, think of it like a Nasdaq performer, right? It's looking at those types of stocks. So it didn't do all that bad. I actually don't know how it closed. I don't have the numbers in front of me at this point, but it was pretty decent for the week. Lamerick down here is a short-term system. So it's looking for opportunity in the short term. And so it is 100% invested in this market. That happened mostly through Wednesday and Thursday's action. The stocks that it owns are very, very different. It is in fact on more of that inflation side of things. It is more on the financials and in the industrial side. The things that have really gotten beaten up and went down, 6% this week are where it's looking for that short-term sort of opportunity to kind of flip those stocks back out. Remember, it's not going to hang around too long here. So it's pretty opportunistically looking at this dip and trying to play it to the long side. by Tuesday of next week, this could be totally back to flat, and then it could be even looking to get short the market. So just be careful on the assumptions you pull from it. We have a very short-term system on the bottom, and we have a longer-term system on the top. So that's kind of the way we look at this. And again, I'm only showing snapshots on a week-to-week basis, so a lot of things can happen in 5 days, mostly with this bottom strategy. So that's it. That's kind of how we're positioned right now heading into next week. If you want to learn more about these trading systems, there's a link in the top right hand. You can click that and you can learn more about both of them and how they operate. So that's it for me on part one. Let's come back in just a second here with part two. All right, we are back. We've got TC 2000 open. We got our equity market grid showing. So what this is the S&P in the top left, Nasdaq top right, Russell bottom left, international stocks minus the US in the bottom right. Price itself is the white dashed lines you see on all these charts, and the multicolored dots are a custom smart trend filter that we've developed for TC 2000. If you're a TC 2000 user, you can download that on our website along with a lot of other scans and indicators for this platform. You can check it out on our website. So we're looking at a weekly time frame here, and I want to sort of talk about things that are the same, and that is 3 out of 4 of these markets basically had no change this week. So the S&P 500, the Nasdaq, and international stocks are all still in a bullish trend, a bullish mode here. And this is important to sort of understand. And remember, this is kind of the framework on how we think about things. We start off with a long-term trend view just to understand what that long-term trend looks like and how we should set our bias or path of least resistance, if that's the way you like to think about it. So even though the S&P 500 was down almost 2%, we're still in a long-term uptrend, right? Nasdaq was up on this week, so that is going to stay in an uptrend. ACWX, international stocks, were down almost 3% this week. We're still getting green dots printed here. This suggests to us that we are still in a long-term uptrend. So that is important to note right at the start. If we look at the Russell 2000, this actually flipped back down to neutral on the weekly chart. So this has been seesawing over the past 3 months now. The Russell has largely been in a trading range, and it continues to be in a trading range. It flipped up. We got a buy signal in the Russell last week, and that came kind of right back down. Remember, we have these 3-colored tier system for a reason. We're not seeing a red breakdown, sell everything, run for the hills. We are just seeing a yellow neutral dot being printed, which basically says, let's reset that bullish excitement you had from last week, because now we're back down to a more even playing ground right now. So that is kind of where we stand. The Russell 2000, the 4% drop did affect the longer term trend outlook going back to neutral. Everything else is still bullish. So this is the weekly time frame. Let's go down to a shorter term view. Let's go down to a daily chart now on all these markets. And you can see we definitely have some different things going on here. So if we start with the S&P 500 in the top left, notice we are getting the yellow dots printed here in the S&P 500. We started the week off with a bullish trend, and that flipped on Wednesday, and it stayed neutral Thursday, and it stayed neutral on Friday. Notice price is pretty below our trend line here, so our trend filter, right, the smart trend filter. So the fact that it is below here, the longer it stays below here, the more likely it is going to transition down to a sell signal, but it hasn't happened yet, and we just need to pay attention to that early next week. So that's a change of character there for the S&P. Take a look at the Nasdaq. So again, this is where strength is now. So we see that the Nasdaq is bullish on the long-term trend. It's still bullish on the short-term trend, and price is well above the smart trend filter. So again, this is showing you where the pockets of strength are. Russell 2000, again, similar to the S&P 500, this didn't transition to a sell signal yet, but it is down to neutral on the daily. And then last but not least, if we look at international stocks, you can see we did get a sell signal here on Friday for ACWX. So we do have a, look out below, or let's be cautious here in the ACWX. And that's sort of the way we are looking at things. So let us get down to a candlestick chart and look at things a little bit closer here. So this is our S&P 500 view, and I need to redo some of these charts. Yeah, so this is, I think, the last working board we've been using. And if you happen to catch our Wednesday trade idea videos, We usually stick to just trade ideas on that, but we actually highlighted the S&P 500 on Wednesday of this week on our YouTube channel because we had that notable action. So basically on Wednesday was FOMC day, and we highlighted the fact on this bar where we saw a pickup in volume, although we didn't really know it yet because we recorded that video in the intraday. But what we did have already intraday was this large volatility wick down here and a loss of this 42.34 level. So basically we had this breakout failure that we talked about on Wednesday, where the S&P 500 broke out above the old highs and started making new highs last week. We stayed up there for a few days, and then we came, crashing right back down below it on Wednesday of this week. And that was our first sort of caution warning sign there in the very short term that, hey, we couldn't hold that new breakout level. We came back down. We saw an increase in range and ultimately did it on some heavier volume. So this was your first warning sign this week. Thursday came along and it kind of left us with very much like this candlestick, pretty much a doji here, kind of opening right where it closed or closing right where it opened. And it did, kind of rally pretty aggressively off of the lows. So this gave you a little hope, I think, on Thursday that maybe the buyers were going to step right back in here very quickly. And then Friday came along and really sort of convincingly took another shot to the sell side here and broke this market down even further. So here's where, I start pulling out the phrases like time frame matters, and you need to know where you live as a trader, because how you approach this market and what your outlook is really going to dictate how important this is to you. So in the short term, I think you definitely have that loss of momentum. It started on Wednesday, and then you got this follow-through session that really occurred here on Friday. So I think you're getting the change of character that you need to be cautious here. You lost the upper level breakout momentum, and you're kind of back in this old range. Now, if you're a longer term, outlook trader, think of like the Merlin trading system that we talked about earlier. We are approximately 2% off of all-time highs, right? I can tell you that our Merlin trading system does not care about 2% drawdowns. That is not significant to it. It doesn't necessarily look at the S&P 500 in percentage terms like this. It's not an input to the system, but I can tell you it basically is not going to care if we're down 2%, right? It's not going to dictate the longer term trend. So that's what you need to sort of figure out and ask yourself is just what kind of move you're playing for, because a short-term trader may be playing to the downside here, where a longer-term, investor or trend follower, or whatever you want to call yourself, might be looking at this to add to positions and, accumulate some risk as we start to sell off, right? So that's kind of the long-winded way to basically say know your time frame. Right now, when I objectively look at the S&P 500, we failed to break out. Let's go to a weekly chart here. So, we made new marginal highs, and then we just saw this big range expansion lower on heavier volume. So this to me says you need to wait a little bit. You need to be a little bit cautious in here, and it could get choppy. And we could just, be back in this range for some of the summertime now between, maybe all the way back to 40.60 is the target for this market to retest these May lows. That would be another, oops, I'm just moving my line here. That would be another 2.5% down. That would be about 6% from highs. That would be a pretty reasonable spot, 5% from highs, pretty normal spot to see the market pull back 5% in the broad averages. So keep that in mind. Not saying it has to happen, but that's where, we could definitely see this just open up to. We've got this level drawn here from old times, 41.70. I think I moved it a little bit, but this was a bit of an inflection area back in here. You can see we sold off right into it, so we can pay attention to that next week. If we look at the IWM, you can see this, and we talked about this last week as, finally getting back to these prior highs here, right? And we essentially said, now's the time to pay attention to the Russell 2000. It's not to get excited because we hadn't broken out yet, but it's certainly time to pay attention to the Russell 2000. I think that was the headline and sort of the takeaway from last week. And you can see we essentially failed here back up at the old highs, and now we're starting to roll back over into this range. So we are very much still range bound with no real character change from a longer term perspective. We definitely, from a shorter term perspective, broke this rising trend line we had been in for a few weeks. We failed at the new highs or the close towards highs, and now, you know, we're sort of back in the middle of the range. The Nasdaq 100 is definitely the best looking right now. So we can see here that on Thursday, we really came roaring back. And in fact, we made new highs on Thursday. So we closed at new highs on Thursday. And then today on Friday, we put in an inside session. So we are, you know, holding currently right at these highs. And the structure here just looks much, much better from a technology growth Nasdaq 100 sort of point of view. And this market definitely looks a little bit better. If we start losing, you know, 337 or so, if we start losing the mid 330s and we start closing below that, then all bets are off, and then I'd be a little more suspect. But until and if that happens, benefit of the doubt, pocket of strength right now is to the Nasdaq 100. Now let's take a look at a few other markets, because we had a lot of things that were interesting. I mean, let's go to VIX first. Let's just see where that is. That's not the VIX. Let's go here. All right, so we got the VIX up at 20, right? So close to 20. I think our chart at the start of this had 19.7. So maybe one of those is not the final values, but it looks like, yeah, back up towards 20 here. So you're getting a nice little spike. I mean, we've had these, you know, sort of series of lower highs here for the VIX over the past, you know, 5 months, 6 months, essentially. So you have to wonder, is this just going to continue to sort of continue in this pattern, this trend, and, you know, maybe the VIX tops out or in the low 20s this time, and then we sort of fade lower as we sort of ratchet down volatility over time. We've been in this trend essentially where every spike in VIX, every worry from the market happens at a lower peak. And so again, I wonder, in keeping an open mind, and it's just kind of an open-ended question that I don't have the answer to, of course, but I wonder if that's just going to continue here like we've seen in this recent rally. We have covered a lot of ground now, so the VIX is up around 40% in 5 or 6 days. So again, I wouldn't, to me, I'm not, you know, rushing out to buy protection here. I don't necessarily know that that's the trade. The trader in me in the short term, again, think of almost like our Lamerick trading system, is almost looking to fade this VIX move. Again, I'm not suggesting that either as a call. So, you know, you got to do your homework here. But I think that this pattern of lower highs is more likely to continue than anything else at this time. So the VIX is interesting there. Let's take a look at commodities. If we take a look at GLD here, so let's go to a different board. We saw, this is a weekly view of GLD. So we saw the heaviest volume we've seen all year, and we saw a 6% down week in gold. So this was a pretty big move downward here. This was a pretty knee-jerk reaction, and you can see the big gap down on Thursday. So I actually stepped in and I bought some gold on Thursday here in a longer term retirement account, basically, that I trade not so actively, right? So something that I'm willing to hold positions for maybe 6 months or so. And I didn't even take a full position because I'm very well aware I could be early on this, but it's something that I wanted to at least start with here. I could envision us, you know, sort of putting in a higher low in here, and this structure on a, you know, monthly time frame isn't the worst. Again, I don't like the way this month is shaping out right now, but I want to just see how the dust settles down here. I want to see if buyers can step back in and put in a higher low before it gets back down into the 150s. So I did put on some gold here. It is a longer term trade. In the short term, this looks certainly, I mean, I guess oversold and extreme, but it does not look pretty at all here in the very short term. So that's what I did with gold. I'm just going to pay attention to it, and I will try to keep everybody updated on how that trade plays out and when I, you know, when I act on it some more. Silver, same thing. I actually did buy some silver as well. So this got hit as kind of the same thing, just like gold on Wednesday. Saw that big move down, reacting off the dollar. And you can see on a longer term basis, this is still very much in a sideways trade trend or lack of trend. So nothing really changed here, but we did get in almost 8% down week, heaviest volume week in some time. And let's talk about the dollar, because yeah, that was something I forgot to mention. UUP here. So if we're just looking at the dollar index, you can see this was where all of the movement came to the upside. If we look on a weekly chart, this is the biggest up week we've seen going back over a year. And it looks like, you know, maybe the dollar could all the way get back up to these April highs in here, which would be around 25.18 or so for this particular ETF. So if that were to happen, then, you know, maybe another percent and a half here for the dollar index. to go. It covered about 2% worth of movement to the upside this week. So if it gets another 1% and kind of gets back up to these April highs and creates a trading range, that would make reasonable sense. And that might mean that we see some continued pressure and maybe a little bit of tough time here for GLD as it settles in. So we'll have to keep that in mind and pay attention to the UUP trade there over the next week or two. Last but not least is TLT. So TLT, Treasury bond long end of the bonds here, seeing some of its biggest moves it's seen in quite a while. It's now had about 5 weeks up in a row though. So we have had the long end bond here now rallying up 7% over the past 5 weeks or so. Remember, it was really kind of brutalized here in the late 2020 and into the first quarter half of 2021. And so now it's putting in this nice little relief rally, and looks like it just wants to continue up here. It is a little stretched to the upside, so it's a tough chase, but it looks like it wants to kind of get back up. Wouldn't be surprised to see it move back up into the 149, 150 area and sort of get close to maybe retesting the old sort of breakdown levels that we saw back earlier in this year. So that was what I wanted to really cover on the major markets. Let's quickly look at the individual sectors, and this video is already going pretty long, so I'm going to not go through all of these. I think what's interesting to note though is, so we usually pick apart with some scans that I've developed some of the more interesting bullish sectors and industries of the market, and then some of the bearish sectors and industries of the market. And so you can see this list for the first time in a very long time basically has nothing on the bullish side. It's only software stocks. So again, that tech theme you can see as this starts to break out or move towards multi-month highs. Nothing else is on this list. Everything here is on the downside. So if we were to look at sort of the sectors that make up this list, you will see lots of basic materials. You will see lots of cyclicals, and industrials is pretty much where the majority of that of the bearish list lives. And you can just take a look here at some of the industries. I'm not going to run through them this week because there's too many, and this video has already gone too long, but you can definitely see what's been selling off here and what's pretty weak. And if you're looking for buying opportunities, if you're a longer term trader investor, then you could look at some of these spots. But certainly if you're a shorter term trader, maybe this is where you're playing on the short side or looking for that volatility to sort of continue. So that's it. That is what I have for this week. Lots going on. Hopefully everybody sort of got through it okay. Let me know, leave a comment below what I may have missed, what you're looking at heading into next week. Let me know what's standing out to you. I'd love to hear those comments. So thanks as always for tuning in and listening. Every Friday we do the videos just like this, keep you up to date with everything that's going on in the market. Make sure to subscribe to our YouTube channel or follow us at thetraderisk.com. Have a great weekend, and we'll see you back here next week.